Okay. Hello, Lauren. You ready?
Yeah, ready? I think we're
Good.
just waiting for some more people to join.
Okay. I'll follow your lead.
Okay, we'll start then because there won't be much to miss in the introduction. Welcome to today's webinar entitled "Company, LLP, or Self-Employed? That is the question we should be considering." My name is Lauren Wilkins, an associate executive in the tax department at the firm. Joined by me today is Matthew Denney. Would you like to introduce yourself, Matt?
Thank you, Lauren. Yes, that's Matthew. I'm one of the tax partners here at Bevan Buckland Limited, as we now are.
Okie doke. So today we're covering the tax implications of operating a business as a sole trader, which would include an unincorporated partnership, a company, or an LLP. In today's webinar, we're covering how recent and upcoming tax changes affect business owners and property investors. We look at the impact of higher corporation tax rates, the increase in the dividend tax from 5th of April 2026, and the changes to the way property income will be taxed from April 2027. We'll be using clear real-world examples comparing self-employment, limited companies, and property ownership, focusing on what actually matters, which is how much money you take home, how much tax is paid overall, and how different structures can change the outcome. So an important point to note is the key aim of today's session is to break the myth that incorporation is a simple one-size-fits-all decision. A few years back, the tax savings from operating through a company were often more obvious. But with changes over the last few years, namely higher corporation tax rates, dividend tax rates rising again from April 2026, those savings have reduced. And in many cases, remaining as a sole trader can now often be the more tax efficient option. We also want to be clear that whether or not incorporating makes sense depends on many factors that are unique to each individual. The examples we use today are deliberately simplified to show how different scenarios can lead to very different outcomes and to help you understand how the various taxes interact. They won't give you a definitive answer on what you should do, because that will always depend on your own personal circumstances.
Okay, thanks, Lonzo. Thank you for the caveat there that it does depend. But so one of the reasons for doing this webinar is I'm often asked, and it sort of kind of frustrates me, the kind of the what people hear from someone down the pub and think it's right, and that's quite frustrating. And the second part, as you alluded to, is all these different changes. The dividend tax rate has gone up. The rental tax rate is going up, and it's just quickly touch on I think some of the background to that. Um, HMRC stroke the Treasury have never really been happy about the way owner managed businesses have used companies to sort of mitigate the total taxation, particularly with income being split between spouses. And if you go back many years, they took on a couple in the Arctic Systems case, and they basically lost. And there's been a few things since. So rather than trying to stop people using companies to reduce tax, they just changed the tax rates, and it has been it has crept up on us, not crept up on us, but it has been over a period of time. So corporation tax went up, was at 19, it's now top rate of 25, and then the tax credit on dividends went, and then dividend rates have been going up. So in a sense, this is just HMRC's way of dealing with the problem. We'll just equalize it. We'll just make it so that it doesn't benefit people. But I think a lot of people still are living in the past. So that's kind of a bit of a background. So yeah, where are we going next, Lauren?
So we'll just start by quickly going through the differences between
So I'll share my
um,
screen. Okay, so you've got
yeah,
them. Okay.
between each structure. So if you are a sole trader or an unincorporated partnership, you're running the business personally, either on your own or in the case of an unincorporated partnership with one or more partners. from a tax point of view, they broadly work in the same way. Profits are treated as your personal income and taxed on the individual each year, regardless of how much money you may or may not take from that business. If you are a limited company, the limited company is a separate legal entity from you as the individual. The company pays corporation tax on its profits, and you pay personal tax when you take money out of the company via salary or dividends, typically. This can offer flexibility, but also comes with increased administration and different tax trade-offs. And then the last one then, where you are a limited liability partnership, this again is taxed broadly in the same way as an unincorporated partnership, with each partner paying tax personally on their share of the profits. So the main difference with an LLP is legal rather than tax related, as an LLP provides limited liability protection, meaning personal risk is generally reduced compared to a standard partnership. So we'll just start now, Matt, by moving on with the illustrations.
I put
You,
my screen now. I think I
yeah.
pressed the button too soon a second ago. There we are. Zach, can you see that?
Yeah, so the first illustration then is a classic example of having business profits of 50,270, so you remain just within the basic rate band. In this illustration, we've assumed that the employment allowance does not apply. Matt, would you like to explain this one in more detail?
Yeah, so we've oversimplified the numbers in all these examples, the chances of having exactly that amount of profit, but just for the purposes of illustrating it, it makes it easier for everybody. So this line is your company. This line is your self-employment. It's easier to start with self-employment because we just take the income tax and the NIC, and then we know what our net position is. And our net after tax that figure would be 40,468. They're more complicated. You've got to compare it to a company. Now, there's two layers of taxation with the company. The company has profits it pays tax on, then you extract those profits. If you extract them as a salary, that's deductible in the company. If you extract it as a dividend, that's after you've paid the corporation tax. So we'll go through sort of a little bit more detail, then it'll get a bit more straightforward because they're consistent, they follow the same pattern. So you won't have to go through every one in this level of detail. But if you've got 50,270 pounds of profits, and as people often do, they take a basic salary. Well, now we've got Rachel Reeves reduced the threshold at which we start to pay employers' NI. So now we've got a cost, an employer's NI cost. So after those costs, that is the profit in the company. It pays corporation tax. It's a small company rate because it's a small profit, so it's 19%. That leaves another 29,617 that can be distributed. Look at the personal tax position of the salary, no tax on that in the personal allowance. Dividends taxed at the new rate now, 10.75, was 8.75. Before Arctic, it was 0 at this rate. So it's, the basic rate has gone from nothing to 10.75% in a number of years. And what this tells us is, and this is before you pay to have a company. You'd have to pay someone like us to run a company. Companies are getting harder. Anyone that's gone through the aggro of company's house identification, I forget the proper word for it, or filling in your PSCs, and filing accounts, doing corporation tax returns. You've got someone to run the payroll. Life's getting harder. So you're worse off before you've even paid your accountant.
Yeah.
Okay.
Okay. So the next example then is broadly the same, except this time we've assumed that the employer allowance is available. So that
So if you come
that
down
right,
to here, it's
yeah,
like that. Okay, you're still better off being self-employed,
yeah,
but not by as much. So you were £1,400 better off as self-employed. With the employer allowance being available, assuming it's available, there are conditions, you're only £590 better off. But throw in all these costs to run the company, and that gap would increase. So that's the kind of the theme of this, isn't it? We're moving to a world where incorporation for sole traders is making less sense.
Yeah. Okay, so
Uh,
I think the next one then is it's following the same pattern, but we're now showing business profits of £100,000. So in this scenario, we'd see some personal tax paid at the higher rate band, the higher rate bands,
just this bit
and the
here. Yeah.
dividend tax is increased as well. So, Matt, would you like to explain that one in a bit more detail?
Yeah, so it's the same theme, which is, but as you have, not surprisingly, as you have more profits, the differential grows.
Yeah,
And partly that is driven by the fact that the higher the higher rate for dividends has increased to this 35.75. So these two figures used to be 8.75 and 33.75. They've all increased by 2 percentage points. Interestingly, the additional rate, which is the top rate, didn't increase. But yeah, so follow the calculation and again, okay, so the company is worse, and that again is before the costs of the company. And these are all assumed these are assuming that you pull all the money out of the company.
yeah,
And kind of the logic would be that at the smaller end, you would need to pull the money out of the company to live. So obviously that would change dramatically if you could leave lots of money in the company, but you would generally expect that sole traders would be drawing all their profits out of the company. In fact, my experience tells me they draw their profits out of the company before they even realize their profits, and in fact draw out the money that is not theirs and is in fact due in corporation tax and find themselves being overdrawn. But we'll possibly come on to that. So that takes us to example four. Uh,
yeah. So this one is just the same as the above, but we're assuming that the employment allowance is available there. Um, so again, we've got a salary of 12,570. The employer NI on that would be 1,136, but the employment allowance, assuming it's available, nets that off. We've got corporation tax at the marginal rate, which is in this case is effectively 22%, because we're above the small profit threshold of 50,000, leaving us with profits to distribute as dividends of 68,013 pounds. So when we then distribute that as dividends, we pay tax at the higher rates, leaving us with a net of 65,747. So we're still worse off, even though we've got the employer allowance, is what we're saying here.
yeah, so the employer allowance doesn't help us enough. So it's helped us a bit. It's gone from 4,000. The difference has gone from 4,102 to 3.5, but still far better off being self-employed. And we haven't got the grief of the company. What we haven't got, of course, is limited liability as a sole trader.
Yeah,
But then, as you said at the outset, if you had a limited liability partnership, you still can have the limited liability, but the tax position of the sole trader. Okay,
yeah. Okay.
so example five.
Yeah, I think this shows the taxes that you pay as a sole trader and a limited company at different profit levels and what the difference in those taxes are.
That's right.
Yeah,
So this is quite useful because very oddly, and I haven't got it here, but this is the profit levels. And this is the total tax, assuming you take all the money out. So as we've seen up here, we're better off being self-employed. And this just shows you the differences at the different profit levels. And it's quite odd. You think it might just keep going up, but it doesn't. It goes up, then it drops, and then it goes up again. And that would look to anybody as being quite counterintuitive. The reason I think this slide is quite important is that previously there was a point at which being a limited company was still better. and it was about £60,000. And I won't explain it because the maths is horrible. Um, but that was up until just 3 weeks ago. So there was maybe people were thinking, oh, I'll still use a company. I think it was still a bad idea. But now it's sort of beyond doubt because at no point does having a company benefit you over being a sole trader or an LLP. Um, we've squeezed this in here. Not sure it's the most any logical place to put this, but it's just worth mentioning that we're talking here about taking a basic salary of 12,570, and if there's not the employer's allowance available, there will be NICs, and historically, lots of people have kept their salary at a level in which there was no NICs or very little NICs. And that got dramatically changed by Rachel Reeves dropping the threshold to £5,000. So anyone with a salary over £5,000 is incurring employer's NI. And the employer's allowance might rescue you, it might not. But what people got to remember is that they don't pay themselves enough, which in this year is 6,708. They don't even get the stamps towards their state pension. So that's an important thing to bear in mind because the state pension, if it's still around when I'm taking it, is still worth a lot of money. Okay, right. Where are we? Example 6.
Yeah.
So if I explain the logic this, then you can take us through if that's okay, Lauren. So
Yeah.
what occurred to people was, oh, we've got this employer's allowance. If we increase our salaries, but not so much we have any employer's NI to pay. So we increase the salaries, this employer's NI goes up, but it's then reduced back to nil by the employer's allowance. So I can pay more salary without any more employer's NI. If I increase the salary, I'll take my profits out of the marginal rate. So getting them away from 25% and getting them towards 19%. So people might think, well, if I pay more salary without employer's NI, does it end up working? Do I end up better off by taking profits out of 25% and putting them back into 19%? So with that hospital pass, Lauren, can you explain this, whether that works or not using this example?
Yeah. Do you want to scroll down a bit? There we go.
Yep. Can you see
Yeah.
all in one place now?
Yeah, so in the right-hand column, we've got this, we're in the same place as we were before. If you're self-employed, with the income tax and class 4 NIC coming off, leaving a net of £69,312. If you are a limited company, and we'll start again with £100,000 profit, you've taken a larger salary because you want to make use of the employment allowance. You've taken £50,270 as a salary. That would have meant that you paid £6,790 in employer NIC, but that's been netted off with the employment allowance. So once you've taken off your salary from the profits, you're left with £49,730 of taxable profits. As that is below the small profit threshold of £50,000, the corporation tax rate is 19%, leaving you with distributable profits after corporation tax of £40,281. So then, from a personal tax perspective, then you've got your salary. The income tax on that would be 7,540, as the first 12,570 would be covered by the personal allowance. There'd be employee NIC to pay of £3,016. You've taken all of the available profits out of the company by way of dividend. So that's £40,281 of dividends. That would be taxable at the higher rate, which is now 35.75%. So that would be tax of £14,222. So the overall net between yourself and the company is 65,774. So, in other words, you're still better off as a sole trader.
So the answer to the question was a good question, but the answer was no.
Yeah.
It doesn't help. But what you could do, and I can't remember if I can do this. So if you had a company, you were already in a company, and you can't very easily disincorporate. You can incorporate without a problem, but you can't go the other way very often without a problem. So if you're already into a company situation, what you might notice is that we've got a company up here where they're taking a 12,500 salary, and this is with the employer's allowance, and the net is 65,747, and you'll notice it's almost no difference between whether your salary is 12 and a half or 50,270. And do you want to touch, Lauren, on what are the reasons why we might take a salary rather than a dividend? If the tax is the same, why is a salary better than a dividend?
Um, it can be more practical to have a salary because the salary is just dealt with via pay as you earn in terms of the tax. So you only ever see the net in your bank account. Whereas with a dividend, you've got to file your self-assessment tax returns every year and pay the tax by the 31st of January. Often people, because they've seen the growth in their bank account, they may not have left enough money over to pay the self-assessment liabilities. And they may have withdrawn it all from the company as well, ended up becoming overdrawn in the company, then have Section 455 issues if you've got overdrawn directors' loan accounts, and potentially not enough money in the company to pay the corporation tax as well. So it can be, if the difference is, if there's barely any difference between a salary and a dividend, sometimes you're better off just taking the salary because it's easier, there's less admin.
Yeah, it's discipline, isn't it? I think what we find is you touched on there not being enough money in the company to pay the tax. What we quite often see is people draw the profits, not thinking that, oh, they'll pay their dividend tax on it. But if you come back, even with this, if you come to this scenario here where you've paid yourself a basic salary and drawn the rest as dividends, the company in this scenario still has £19,500 of corporation tax. If you've drawn that money out, you can't declare it as a dividend because you probably can't declare it as a dividend because there aren't the reserves to pay the dividend. So the accountant can't fix it by declaring a dividend. Sometimes there are things that can be done, but as a general rule, they can't fix it. Then you become overdrawn. And then if you don't repay the overdrawn amount, the company pays like a penalty tax, what you call the 455 tax. It's a tax that's refundable, but very hard to get back. It's sort of a downward spiral, really, and then you can end up in a situation where you just find you don't get on with your accountant anymore because he's telling you got all this tax to pay. But really it's self-inflicted. You sort of if you've inflicted this on yourselves when you could just have taken it through pay as you earn, and then everything is dealt with and you're not going to have any horrible surprises. Right, I've lost because I flicked back up, I've lost where I meant to be.
I think you're meant to be that this example 7, I think.
Sample 7, perfect.
Yeah, which I think you've done different.
Yeah, it's sort of a
Yeah,
different way up here, isn't it? But it's just to make that,
yeah,
pay as you earn, discipline. So that, as we just explained, it's like there's nothing in it. There's there's
yeah.
nothing in it, whether the salary's 12 and a half, 30,000 pound, 50,000 pounds. So if you kind of know, and also if you want to go and get a mortgage, sometimes it's better to have a P60 with 50, well, it's not always, sometimes it's always better, isn't it? It's always better to have a P60 with that figure on than with that figure on. But where it really hurt people was during COVID and furlough and the
Yeah.
number of people that were up in arms. But there was no sympathy from HMRC or anybody else because people had taken this salary for tax purposes, and then so Yeah, there's other reasons. Yeah, I think I've hammered that point. Right, where are we going next?
Okay, so um, in this example, we're assuming now that a company has been established, um, and there are £100,000 of profits, but the business owner doesn't want to withdraw all of the profits. So I think we're capping the overall drawings at £50,270. But then we're considering, is it better to take that um, as a salary, so a full salary of £50,270, or to take it um, as a basic salary of 12,570 and the rest as dividends.
Yeah.
Yeah.
Is it best we just you just walk through this one? So this is
Yeah.
an odd situation where it's unlikely, but it's possible that you don't need to draw all the money and would like to take advantage of deferring that until another time when
Yeah.
circumstances might change. And then, so rather than having all the money drawn out and paying the higher rate of tax, you're keeping yourself to the basic rate of tax. And then the money that's left in the company is taxed at 25 between 19 and 25%. This is not really apples and apples comparison, but it is to illustrate um, if you were to leave money behind, which way you might do it. And this is actually produces some very interesting results. So, do you want to talk through
Yeah.
the
So if we
numbers?
start with the company position then, so
Yeah,
we've got the company profits of £100,000. We'll start with the left-hand column. So we'll assume the salary is £12,570. The NIC on that would be 1,136, but we're assuming that the employer allowance is available. So that gets netted off, and we have a taxable profit for corporation tax purposes of £87,430. Again, that profit is more than £50,000. So we've got this effective rate of corporation tax, which is somewhere
I'll just do it
between
for you there. There we
19 and
are.
25%. So we get some marginal relief.
Yep.
Um,
This one we do. This one we don't. So this one is. Oh, there might be a little bit in there. Okay.
it's because we've done the marginal relief is underneath on that
Oh, I
one.
need to do the two together. Okay, I
Yeah.
won't even try. You carry on, and I'll do it in the background.
Um, so the net profit after paying the corporation tax is £68,000. We're only going to draw £37,700 from the company in dividends to give us that £50,270 total. So left over in the company, we've got £30,311. Oh, there we go. We've got the effective rate of corporation tax there at 22%, or
Okay,
22.2%.
perfect.
Um, so then in the right-hand column, again, we're starting with £100,000 of profits. The director's taken a salary of £50,270. There would be employer NIC of 6,791, but we're assuming the employment allowance is available. So that gives us a profit of £49,730. So here, what the profit is less than 50,000, so we get the small company rate of 19%, and that gives us profits left over in the company of £40,281. So here, the company is better off by £9,970 as a result of that income being taken as a salary rather than a salary and dividend blend. So now, if we go on to the personal tax position, starting in the left-hand column, we've got a salary of £12,570. There wouldn't be any tax on that or national insurance or employee national insurance because it's within the threshold. The dividends are 37,700. That would all be taxed at the basic rate band, which is 10.75%. So that gives us net personal take-home pay of 46,271. Compare that then if you've taken £50,270 as a salary, you pay income tax of £7,540 and employee NIC of £3,016. So from a personal point of view, you're worse off by £6,557 by taking that income as a salary. So the position is different then for the company and personally. But overall, when you combine the two, you're better off by £3,413 if you go down the salary option rather than the combined salary and dividend option.
So just to clarify that, because this is like a real conundrum. And if you think of it, because it's your company, so it's your money. And so overall, you're quite considerably better off by having paid yourself a salary. But because you took a salary, you're paying tax at the 20% rate, and then the employee NIC is 8%. So net in your pocket to go and spend is a lot less. It's a lot less. But if you think you're going to pull that money out later or can use it in the company to invest, whatever it might be, that's not, that's a sizable difference to be aware of. And it's perverse. This is if I was ever going to use a slide to say our tax system is stupid, it would be this slide. It's just it produces a very counterintuitive and sort of kind of crazy result. But that's what we're up against, I'm afraid. That's what happens when politicians say things like we won't raise taxes on working people and run out of money. You get a mess, I'm afraid. Okay, so that was interesting. Where does that go to now?
So we've now got this example where we've added in some more complexities of an individual who's got some child benefit and also pays a plan to student loan repayment.
So this
So
is
we,
our kind of like this
yeah.
is our going from the sublime to the ridiculous. If it was the point was to say, isn't the tax system crazy? Well, hold my beer. Let me show you how really stupid our tax system is. So can you tell us how mad it is by take us through what did you do first? That one hasn't changed, has it? So that we know
Um,
sole trader is the
yeah.
same.
So the sole trader, the tax
Oh, so you're the
would
same as
be,
he's got the sole traders losing his child benefit and he's got to pay back a load of student loan repayments.
yeah.
Right. So what we're saying is if he's a company, this individual can avoid these problems by restricting their income that they draw from the company. Is that right?
Yeah, that's right.
Okay.
Yeah, they would still have some plan to student loan repayments, but it would be less. So we've restricted the income to 50,270.
Right.
There'd still be student loan repayments of 1,880, but that would be compared to if you were a sole trader and you're taxed on all the profits of 100,000, you'd pay 6,355.
So this is an example where a company could be used to manipulate other aspects of your tax situation. And where do we end up with? So the total, if you were in a situation where, so if we compared this here, that's quite a high rate of tax now. This poor individual has worked very hard to make £100,000 and ends up paying an effective rate with all this of what is it, 30, um, is it 37%? Whereas the person who had the company has ducked all of the child benefit repayment because their income is below the tapering threshold, and they've ducked quite a bit of their student loan repayment. Yes, they've had to keep some of the cash in the company, but that's a lot of money overall to retain that can potentially be drawn at a time when you've got less income or or expended in the company. So that starts to, so having started this whole thing with sole traders better, we also started with, well, it depends on circumstances, and there can be some odd situations depending on how much money people need to draw out their businesses. Some people will just be thinking about when they can go abroad, frankly. So I'm being very cynical. So yeah, I think this is really helpful way of seeing it when you build it up like that. So does it
Yeah.
just okay, so where do we go next, Lauren?
So we're going to bring in now the changes to how property income will be taxed from April 2027. So do you want to introduce a little bit about that, Matt?
Yeah, so the this goes back to my comment about, we won't increase taxes on working people, but of course landlords aren't working. Passive income, there's no work to being a landlord, obviously. So they were able to increase taxes on landlords, and they don't come in now, they come in April 27, and they basically put 2 percentage points on all rates for landlords. Albeit we understand that that suffer the Section 24 tax, that's the restriction on the interest you can claim, is not staying at 20%. That will also go to 22%. So it's not a double whammy. That would be kind of outrageous. So um, this example is here because there's a difference between the rates on rent than there are on being a self-employed person. So how does that play out between a company and an individual? So take me through this one, please, if you wouldn't mind, Lauren. So we'll start here.
Yeah, so we're assuming here that this individual has got other income from an employment of £12,570. So we've already used the personal allowance just to make it a bit more straightforward.
Yeah.
And they have profits from a rental business of 37,700. So their total income is going to be £50,270. They're not going to be paying higher rate tax, but they're going to be right at the top of that basic rate band. So if you just owned that company personally, you'd have the profits of £37,700. You'd pay the tax at that new rate of 22% from April 2027, leaving you with a net of £29,406. But then if you go to the left of that and you instead own that property through a limited company, and this would be assuming that you withdraw all of the available profits. You pay corporation tax at 19%, leaving you with £30,537 to be distributed. You pay dividend tax on that then at the basic rate of 10.75%, leaving you with net take home from the property business of £27,308. So in that example, then you're worse off having that property in the limited company by £2,098. But then to the side of that, we've got another example where maybe you want to leave the profits in the company, so you don't extract any dividends, so you haven't got any personal take home pay from that, but you've kept £30,537 in the company. So there is a saving there. So if you scroll down slightly, Matt, I think the
Oh, it's
saving.
there. Yeah.
So there's a saving of £1,131, but you haven't taken any of that money for yourself personally.
Yeah.
And that is again.
What's interesting about this is it's sort of quite clever in the sense that if you've got no mortgages, no one's going to rush to incorporate if they need the money because you're still better off holding the property personally, which means the government could squeeze these rates up and there would be still nothing you could do about it. They've hammered the CT and the dividend rate so much, they can now squeeze landlords by increasing that rate by maybe another percentage point in a couple of years' time. And people still won't rush to put it into companies because they've already put up the dividend rates to make it unattractive to put it into a company and take the money out. So they've got us. I'm afraid they've got us every which way. as a landlord.
So if you then scroll down a bit, we've got a further example. So um, here we're saying that the individual has got a bit more salary, so their total earnings are from their employment is £50,270. They've got rental profits of £49,730. So they're just at that £100,000 of total income. So in terms of the property business, then if they held the property personally, they'd be taxed on the full amount of £49,730. So at that new rate of 42%, that would be £20,887, leaving you with a net of £28,843. Again, then from if you had a limited company and fully extracted all the available profits, you'd pay corporation tax of £9,449. You'd be able to declare a dividend of £40,281. That dividend would be payable then at the higher rate because we've already used all of our basic rate band. So the higher rate of 35.75%, that would be £14,222 in tax, leaving you with a net of £26,059. That shows that you're better off owning that property in your personal name by £2,784. But because we're now higher rate, the savings of if you were to incorporate and not withdraw the dividends are more. So you'd still pay the corporation tax, which is the same, £9,449, but you're leaving all that you're leaving all of the profit in the company. So the company retains £40,281. You haven't had anything personally in your pocket, but overall, between you and the company, you're better off by £11,438. And that then can be used to reinvest in more properties and grow the portfolio. So it just shows that the savings are more depending on what your highest rate of tax is.
So it's again on the same theme. It's if you can leave the money in the company, it can help you. But if you're drawing all the money out, they've got us. Like, we're still, even with the 22% and 42% tax, we're still better off without that mortgage, without any mortgages holding the property personally. And so this is a situation, same figures, but we're going to have
Yeah.
a mortgage. Is it this one with a mortgage?
Now this one is it's the same kind of example as before, but we're saying that they've got even more other income. So they've got employment income of say £100,000. And then their
Okay.
property income is £50,000. So in this scenario, it's the same concepts as the first two we've just gone through, but in this scenario, having that property income personally tips you over the £100,000. You lose all of your personal allowance. So that's what that £5,028 deduction is there. So that's the loss of your personal allowance.
That one there.
And then and then the property income tax personally at 42 and 47% then.
So if you hold the money in the company, if holding the money in the company gets you out of that 60% tax bracket where you're over 100, it could be quite compelling again, but you need to be able to leave those profits in the company. So in this situation, by not taking the profits, the overall tax saving was 11.5. When you're in that awful situation of paying 60% tax, that you couldn't ignore that as a potential saving. And of course, you might be able to leave the money in the company as a pension pot and only draw it out at the 10.75% rate when you're retired. And the thinking being that if you're earning this kind of money, then possibly you don't need to take the money out of the company to fund your lifestyle.
Yeah.
Okay.
Okay. And then the last one then is bringing the mortgages into it. So as you mentioned, if you own the property personally and you've got a mortgage on it, then there's a restriction on the amount of tax relief you can have on the mortgage interest. but currently that restriction doesn't exist for limited companies. So if we start with owning the property personally, we've got profits of £49,730. We've had to pay the mortgage interest of £25,000. So the net of that is £24,730. But from a tax perspective, we can only get we're taxing 42% on the £49,730 because that £25,000 of mortgage interest isn't deductible. But we do get some relief, but only at 22%. But in this scenario, we're saying that the individual is a higher rate taxpayer, so they're losing out on relief of effectively 20%. And so that leaves you with a net take-home pay from the property business of £9,343. But comparing that to a limited company, the company would have profits of 49,730. They can deduct that 25,000 from their taxable profits, meaning that they only pay corporation tax on the £24,730. And again, this is assuming that you're taking the money out as dividends. So you've taken out the rest, which is £20,031. You've paid higher rate tax on that, at the higher rate dividend tax of 35.75%, leaving you with £13,049 net take home pay. So the difference there is £3,705 and that's better off by holding the property in a company.
Now this is quite an extreme example. You'd hope not to have that much mortgage interest. Otherwise you'd have a lot of property. But all these examples have been oversimplified to explain how it works. But this is the point of this is to illustrate that up here, where the property's held personally and there's no mortgage, if you're drawing the money, even if you're paying even though the rates have gone up to 22, 42, 47, it's still better to avoid the double layer of taxation. You don't benefit from the CT rate and the dividend rate because the dividend rate has also gone up. But where you have mortgage interest, and this is an extreme amount of interest, you can be in a situation where the punishment of the Section 24 rules are so severe that the company is better. Now, of course, there are issues with getting the properties into the company, which is another topic altogether. But when you get into the realms of properties, that's when you need very specific advice because there's lots of other complexities that need to be thought about. But I think it was worth showing, building up how you get to this, this more complicated picture as you bring different things in. So we sort of, we dealt with sort of simple, then we threw in some complexity with student loan repayments and child benefit, and then we threw some properties in. And I suspect by now everyone's not necessarily confused, but perhaps a little bit annoyed by how complicated the rules are. And honestly, if that's the one thing people take away, that whoa, it's complicated. That's not a bad place to be because then that does what we want to achieve, which is sort of busting that myth of I'll go and get a company, it'll save me money. And they go, oh, actually, I saw this webinar and it's really complicated. I better look at it more carefully, and take into account all the sort of circumstances because there are some. Whilst there might not be much difference, and you might just take all the money out and take it as pay as you earn, and it makes no difference depending on exactly what you're trying to achieve, there can be some very considerable differences in the way you do things. If you're able to, companies are maybe much more useful if you're able to hold the money in the company, and much less useful if you need to pull the money out of the company. Right, I'm just conscious we've done 50 minutes. It's flown by. Have we missed anything, Lauren?
I think we got through everything.
Good. I forgot, I don't know if we mentioned there is a Q&A box. But I don't know how I show people where it is. It's kind of like these three dots at the bottom of the screen where it says more. So I don't know if there's any questions. I suspect there's not, but I will just check if anyone wants to quickly put a question on. I'll just sort of um bumble on a bit longer. Um, uh, yeah, so some interesting examples. Ooh, I've got an interesting question there. So the question is, why has Bevan and Buckland become a limited company? Um, it's a good question, and the answer will become apparent, but not today, I'm afraid. It was that. Good, good. Nothing else? Okay, excellent. Thank you, everybody. It will be available on YouTube if you did want to sort of see the examples and you're on an iPhone and that you couldn't quite follow them. So there will be a link somehow, I think, sent out. Um, and so, please do follow up with any sort of specific questions on your circumstances to your sort of usual contact at Bevan Buckland. Thanks, everybody.
Thank you.
Thanks, Lauren.
Thanks. Bye.